Hi, everyone. Thank you for tuning into our NBI podcast. Today's topic will be on the Canadian economy, and to do so, I'm joined by Daren King, a senior economist with our economics team. Welcome, Daren.
Thank you for having me.
Daren, we can't help but talking about what's going on worldwide in Iran and the Strait of Hormuz and the impact it's got on the Canadian economy. So can you tell us about the oil shock right now and the impact on not only importers, because we're net importers in Canada, but also maybe the impact on consumers?
Yeah. So like I just said, we are net exporters of energy produced in Canada. So that's a good news because we won't face scarcity like maybe some countries in Asia or Europe. So it means that for consumer, the real impact will be on prices. We won't face scarcity. We won't have to do some sacrifice in our day-to-days, but definitely it will cost more for households to buy some products, notably gasoline, but we'll probably see a second round effect later this year, because even if the conflict stops tomorrow, there's a backlog. Even if we reopen the Strait of Hormuz tomorrow morning, it will take some time before we can catch up with all the deliveries of produce that was stopped during the past few weeks.
Yeah.
And also there we saw price increases in several other produce that will have an effect down the road, notably fertilizer, sulfuric acid for chips for AI, for example, and stuff like that. So we can expect that we'll see higher food prices in the next few months, or other products like that are really energy intensive, for example, aluminum. So the impact on inflation will last longer than only the direct impact of the conflict. So that will definitely means more inflation for Canadian, but probably we won't see the direct impact on consumers, like I said, on the economy directly. But for some provinces, that means opportunities, obviously, for provinces like Alberta, Saskatchewan, Newfoundland. But for other, it will probably mean more inflation. That is not good news for households and businesses, notably in Quebec and Ontario. It will be a more negative impact.
It's sort of a tax on consumption.
Yeah,
some sort,
exactly.
Right?
So there will be some winners, some losers. Overall in Canada, I think that will be a winner, but for some provinces, there will be some losers, yes.
Okay. So you talked about inflation and the short-term impact versus the long-term impact. Can you just give us a view of where inflation is right now and what's creating more inflation or less, and what's your view on what's coming?
So with the latest CPI data we've had for March, we definitely saw a pickup with the increase in oil prices around the world, in Canada, in the US. But the good news is that when we're looking at core inflation, so when we remove energy and foods, essentially, we saw a slightly lower increase in what was expected by economists. So it means that we're starting on a good footing to, if we are a central bank, to fight that inflation, especially in Canada, because since the end of last year, we saw a downward trend in inflation that was really welcome.
Yep.
So it gives the Bank of Canada more leeway when it comes to fight inflation in the next quarters. Not so much in the U.S. Inflation picked up at the end of last year, still above the target of 2% by the Fed. So they probably have less a margin on the south side of the border, but we have more margin here in Canada, so that's a good news. But since it's a supply shock that we're facing right now, the ability of the Bank of Canada to respond to that shock is very limited, because when you're the Bank of Canada and you're increasing or decreasing your policy rate, you really have an impact on demand, on the ability of household to buy more stuff or businesses to invest more. You can drill oil with interest rate, obviously.
Yeah.
So
monetary policy can't fix a supply shock.
Yeah, exactly. It can on the long run if you keep interest rate low for a long period of time, stimulating investment, creating new supply capacity. But it takes many years to do so. So in the short run, the real impact that they can have is really on demand. So that's why the Bank of Canada will probably try to stay put for the moment, trying to look through that shock to see what will happen. And if the conflict lasts for a long period of time, there's also the scenario where we're going through a worldwide recession. And in that case, if they try to increase interest rate right now to fight inflation, which limited effect because again they are only impacting demand, they will just it will only be a situation where the economy is going even worse than what we want. So that's not the best case scenario, because if we have a worldwide recession, ultimately Canada will be impacted, even though we are in a better position for the moment. So it's a dilemma for the Bank of Canada right now. So they will probably try to stay put as long as they can before they really need to do something. But for the moment, we were optimistic that they won't change their interest
so
rate.
You're sort of in disagreement with what the market is expecting at the very early stages of the oil shock or the tantrum in the Strait of Hormuz. Oil prices went up above $100, and then the market started pricing like three rate
that
increases.
Went down. That's a good news. So
that didn't make much sense to you guys.
No, exactly. It was definitely overpriced. So market came interest rate hikes expected by the market came down since then sharply. They are now expecting probably one hike by the end of this year, but that wasn't our scenario since the beginning. So we will probably see the Bank of Canada stay put for the entire year, and we might expect them to increase interest rate at the beginning of next year by once or twice, but really to come back into the neutral zone, because now they're slightly in accommodative territory. So they'll probably try to return to neutral, but it's not because they really want to fight inflation actively, but really just to get more ammunition if there's a downturn in the next few quarters.
Got it. Okay, so we've talked about short-term interest rates. What's the impact on longer-term rates, and perhaps in this environment where there's a lot of fiscal spending, when there's a little bit of inflation, as you said?
So definitely, the dynamic is very different than for short-term interest rate. If you're an investor and you are expecting more inflation, you want to be compensated for that expected inflation. So we have already seen longer interest rate that went up over the past few weeks. But there's also, like you said, all the question of the fiscal policy that we have here in Canada and in the U.S. with the One Big Beautiful Bill, for example.
And in Europe, for that matter. It's a worldwide phenomenon.
Yeah, exactly. We're talking a lot about Canada and the U.S., but that's a worldwide thing that we're seeing, that governments are spending quite a lot. And in Canada, I think that obviously we are going through a structural change in the Canadian economy with the trade conflict with the U.S. We need to do investment to diversify our supply chain and exchanges. So I think that the supply, the fiscal package that the federal government is putting into the economy is a good thing, because also the Canadian economy is going probably a bit slower than what it could be at the moment.
Are we going to see the impact of that in 2026, or it's just something that's coming?
Yeah, it's something that will be seen probably in the coming years. It takes some time before the plan is executed and we see the fruit of those investments. But in the U.S., since the economy is more at an equilibrium at the moment, already running like at its potential, that will probably means more inflation. So again, more inflation because of that of those fiscal spending means higher interest rate, but also there's the question of the sustainability of debt or deficit. Yeah, exactly. We've seen the U.S. that have been the credit rating have been decreased over the past few years by several credit agencies. We've seen government around the world, notably in the UK, where the Prime Minister proposed a fiscal package that was completely not accepted by the markets. Obviously, the U.S. is I mean, is a bigger player. We'll probably we won't probably see that, but investors are getting more concerned about that question. Obviously, if you're lending money to someone and you don't know if they'll repay you down the line, you'll probably charge a higher interest rate to hedge your risk. So that's the same thing that we are seeing in the bonds market at the moment. So we are expecting higher interest rate on the long part of the curve in the coming years.
Okay, so what does it mean for mortgage rates?
Obviously, like I said, we're not expecting the Bank of Canada to cut its interest rate. So variable rates are probably at the lowest level they'll be in some years. Except if we have a worldwide recession, then it's another story.
That's a very pessimistic scenario.
Yeah, that's a very pessimistic scenario. That's not what we're expecting. Yes, they are their lowest level they'll probably be. And for fixed rate, they'll probably go up in the next few months and in quarters. So if I was to renew my mortgage tomorrow, obviously it depends on your risk profile, but I would probably take a fixed rate. 3 or 5 year, I don't really have a preference. Will we really have lower interest rate in 3 years? If you take a term of 3 years, I don't have really a lot of conviction for that. So 5 years might be a good option. But yeah.
Okay. So what are your views on? We talked about Alberta. Maybe the oil shock is a positive for them, but for the consumer, tariffs. Higher oil prices. Are we seeing sort of a slowdown in the Canadian economy? What's your view on that?
Yeah, I think that there are uncertainty surrounding the trade conflict that we have with the U.S. is still being felt in the economy definitively, even though we are getting used to it. I think that the CUSMA renewal this year is something that is very important to dissipate that uncertainty. So if we can renew the trade agreement with the U.S. and Mexico as fast as possible and as seemingly as possible without Trump derailing completely the negotiation when he can.
What's the probability of that happening?
I think that we will see a deal. Definitely we'll see a deal, but it will depend on how long it takes before we have that deal, because it's really the uncertainty that is damaging the economy right now. Because when we're looking at the effective tariff rate that Canadian exporters are paying, they're not paying it, but the U.S. is paying for our produce. It's very low. It's around 4%. But it's really some specific sectors that are really impacted. Wood, cars, aluminum. So there's provinces like in Quebec, in Ontario where the impact is bigger compared to Alberta, Saskatchewan, where the impact is very limited. So there will be losers and winners there as well. But I think that we'll see a deal down the line. But the uncertainty is certainly slowing down the Canadian economy. And at the same time, we're seeing an historical shock on the demographic front. Mm-hmm. So we've seen historical growth with 1.5 million people coming in the country in 2024. Now we're expecting the population to decrease for the first time in history in Canada. So that's another drag for the economy. So we're expecting productivity to increase to compensate for that decline in population, but it takes time. Interest rate for business want to invest for some productivity in its business. They didn't went really down, even though the Bank of Canada cuts its interest rate for all the reason we said earlier. So it's tougher for them to take credit. It costs more, obviously. So those productivity gains will probably take more time to be seen. So that's why we're expecting still a sluggish growth in the Canadian economy in 2026, but probably a pickup in 2027 with less uncertainty, more investment, and the fruit of those investment coming into the economy. So still a sluggish economy in 2026,
but not like a standstill. We're talking about what, like a 1.5% growth.
So for this year, approximately 1%, roughly, but probably 1.5% next year in Canada. Yeah.
Okay. Last question about the real estate. What are you seeing? We know condos in Toronto are feeling the brunt of all of this. What should we expect for 2026?
Yeah. So the real estate market is really interesting because we're getting back to the normal dynamic we had before the pandemic. Before the pandemic, we were talking not about the real estate market, but
segregated
real estate markets, and with different
Montreal
regional,
always lagging, Toronto always lagging, Vancouver.
Exactly. So it was very different depending of where you are. So, but during the pandemic, it was like one big real estate market. Everything went up and down at the same time.
Everything doubled.
Yeah, but now there's places where it's going down sharply, and that's what is very different right now. When we're looking at markets as Montreal, Quebec, Calgary, for example, those markets are doing pretty well. Actually, transactions remain high, in line or slightly above their historical average. So normal activity, LT normal activity, with prices going up slightly. So balanced market or slightly favorable to sellers, so that's a good thing. But for markets in Ontario and in BC, it's very, very difficult at the moment. You talked about the condo market in Toronto, but it's not just the condo market in Toronto; it's the entire Toronto market that is very difficult at the moment.
So what's the culprit? What's the higher interest rates? Over construction?
I think we're still seeing a lack of supply everywhere in the country. We'll talk about that probably later. But what is the biggest reason for the slowdown that we're seeing is really affordability. I mean, the prices compared to the
rest of the country,
the rest of the country, and the households' capacity to pay for those units remain very unaffordable. I mean, so if you combine unaffordability with uncertainty, it magnifies the effect on the real estate market. It's a very big financial decision, and you don't know if you will still have a job tomorrow morning. So for those markets, we really had sharp slowdown. Those are also the market where we are seeing also the biggest slowdown in demography. So it's actually the perfect storm for a slowdown. And we've seen prices that has decreased sharply in those markets. So for some people who purchase a home over the past few years, if they want to sell tomorrow morning, they have a negative equity on their home. So it's like stuck in the market because people won't sell their home. People are not able to buy those homes at those prices. So we're seeing lower transaction volume and prices that are continuing to decrease. And we'll probably see for Toronto and the Golden Horseshoe in general, and in Toronto, in Vancouver, price that will continue to go down this year. And nobody wants to catch a falling knife. If you are buyers, you'll try to buy when you see the market is picking up or stabilizing. So it will probably still take some time before we do it, but affordability will remain a big issue around the country for probably the next few years, because at the same time you have home builders that see higher financing costs, higher construction costs, lower demographic, with a resale market that is essentially frozen. So if you want to buy new units at the moment, it's very difficult to launch new product. So down the road, we want new builders to continue to build, because that's the only way we'll restore affordability across the country. But for the moment, it's very difficult for them to do so. So affordability will remain an issue probably for the next 10 years.
Yeah. Very interesting, Daren, and I'm sure we can talk more about that in the near future. But for the time being, it's all the time we had this morning. So thank you very much for joining and participating in our NBI podcast. And for those of you watching or listening, thank you for tuning in too, and we'll talk again next month.
Thank you.